Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis on Monday, October 27, 2014. Here's a daily chart of the SPY. And basically we had a stuck in the mud day, a pause day, a nothing going on day. And this always happens on the week that the Fed is going to say nothing on Wednesday afternoon. So since the Fed is meeting tomorrow and Wednesday, the market's in pause mode. Tomorrow, you're probably going to get more of the same type of action, narrow range, maybe a little bit down, a little bit up, but in the end of the day, nothing much should happen unless there's an event. And then Wednesday, the market will whip around in the afternoon after and around the Fed meeting, and then it'll settle in and do what it's going to do. So what's it going to do is the question. Here's what you have. I'm going to give you both upside and then the other side. Upside, you kind of have, there's a number of numbers in here that could be, should be, would be targets for the S&P on the upside, or the SPY. But instead of giving you all the targets, because it's a fool's game, if I say, 197 is a target, then it'll go to 197.5. And if I tell you 197.5, it's going to go to 198. So what I'm going to say is the likely scenario is the market is going to stay beneath 199. Now, that's a wide range from where we are now. That's 30 S&P points. So I don't want to give you the wrong idea. I'm not trying to, hit a huge target with a small bullet. I'm just saying that the market finds a lot of resistance in this area. This is resistance. This 50 moving average is resistance. This next high is resistance. The next high after that is resistance. This is where originally, when the market started down and you had these couple of up days here, for example, these are where some buyers came in. This is where the buy the dippers came in here, the buy the dippers came in here, then again here and here and here. And what happens is every time the buy the dippers came in and the market sold off, the buy the dippers are stuck holding the bag. So what you're finding up in this area is you're running into resistance because the buy the dippers are selling to get even or close enough to even. So there's a lot of resistance in this area. Could we break through? Sure we could. But right now, until further notice, at least the next couple of days, I wouldn't look for a lot of upside. After the Fed meeting, you can certainly get a spike, and even a spike up 15, maybe even 20 S&P handles. But that usually settles back in if that's the case. We'll see what happens. What are you looking for from the Fed? Well, let's see. Let's go over a couple things. You're not looking for anything, but here's a couple of things. The Fed is anticipated to stop their bond buying program, meaning end the taper of the bond buying program, which means no more buying bonds. Okay. Whether that happens or not, I'm assuming it'll happen. Let's assume that happens. Everybody knows that's supposed to happen, so there'll be no news there. Even if they don't stop the buying program and they continue to buy, 10 or 15 billion a month in comparison to the bigger numbers of 4 trillion that they accumulated over the last 4 or 5 years, it's nonsense. Okay, so there's a non-event there. They're going to give an assessment of when they might start raising interest rates. They're not going to change anything. They're going to say sometime in the future. They're not going to give you a date. People will be guessing dates, first quarter, second quarter, third quarter, 2015. Who cares? It doesn't make any difference. If they raise them at all, what are they going to raise them? 25 basis points? 50 basis points? That has an impact on nothing, okay? What else are we looking for? Their assessment of the economy. Well, since they're wrong 80% of the time, who gives a hoot what they say about the economy? And even if they say anything, they never tell you the economy's weakening. They always tell you that, the economic numbers are improving and they're monitoring the numbers and they'll do whatever they need to do based on the data. That's all. They always say the data, the phony data. So what I'm trying to say is the market will whip around the Fed, but the Fed they don't really do anything. They don't really know anything. It's all conjecture. It's all bullshit. All right, next. So what would send the markets higher? That's what we need to focus on. What type of event would send the markets higher? We know some things that could send the market lower, right? problems in the global economy, problems in Europe, problems in the U.S., earnings, terrible earnings could send the market lower. Could good earnings send the market a lot higher? Not so much. Maybe a little bit, but not so much. We've had a huge move off this bottom here. Okay, so how much higher can earnings push this market? Probably not much. Europe. Mario Draghi is negotiating with Germany and probably some other countries to get the nod to institute a bond buying program like we've done here over the last several years. Okay, the European economy, the European Central Bank is behind the eight ball. Okay, they're late. When we were cutting rates, they were raising rates. Okay, so they're lopsided. Now their economy is spiraling out of control. Okay, their banking system is screwed. Their economy is slowing. They have countries that are teetering on default, even though they cover it up. It's just in shambles. So what you have is you have a guy, the head of the central bank, that wants to print money. If the economy looks bad enough, they'll finally give him the go-ahead. He'll start to print money. They'll inflate the European economy. The U.S. markets will cheer. The global markets will rally, and that would send the markets higher. Okay? Now, that may or may not happen soon. Okay? If it doesn't happen soon, it will happen on the next global market sell-off. Okay, so that brings us to the next question. Where do we go on the downside? Well, let's take a look. So if we just assume that the market tops out here, and I'm not assuming that, I'm just saying if it does, okay, 196.5, 197, okay, where would we go? Well, the first stop would probably be to 192.5, 193. Okay, that would be about a third of the retracement. Okay, let's call it 192.5. This would be the 20-period moving average. Okay, if that's the first stop, the second stop is around the 50% retracement, right about this level here. Okay, and then you'd have a 7.5 or a 6.18 retracement right in this area here. Okay, and we take those one step at a time. Do you expect a collapse in the market? It could happen at any time, but it's a black swan. You can't say a collapse is happening next Wednesday, but you got to be cognizant of the fact that it could happen at any time. Remember 2010, we saw a flash crash. If heavy sellers come into this type of market, okay, the buyers will dry up, and that's what causes a flash crash. So I'm not saying it's going to happen, but I know there's been a lot of talk out there. There's a lot of blogs coming out with people saying there's going to be a crash, the market's setting up for a crash. Maybe it is, maybe it's not. But it's nothing you can really predict, only maybe once in a lifetime. But if you do, most of the time you've gotten lucky, because the people that predicted the crashes, right? You always have these people, some of the astrologers and some of these guys and that guys, they come and they say, well, I predicted the crash of 87, I predicted the crash of 2000, and maybe so, but they're the same people that predicted 15 crashes and they got one right. Okay, so eventually, if you keep saying the same thing, you're going to be right. A broken clock is right twice a day. Okay, so yeah, there's some people that are really good at predicting market moves, but at the same time, when they say I predicted the crash of 87 or the crash of 2000 or whatever, okay, that doesn't mean, and they're not telling you that they predicted 15 other crashes that never happened. Okay, go find me the person that predicted the flash crash in 2010. Okay, I want to see that guy. All right, anyway, let's move on. I spent a lot of time in the markets, the stock market tonight, so let's just run through gold, oil, and some other stuff real quick, and we'll get you out of here. Gold is into the 20-period moving average. I still think there's one more up move in gold, but after that, I think it's lights out. And I'm going to stay with that conviction. I know there's a lot of people that don't like to hear that. And the more I talk about that, the more people that don't want to hear what I have to say. It's kind of interesting. They only want to hear what they believe. And if it's not what they believe, it must not be true. Don't get caught in that scenario. I may not be right in gold, okay, but don't be caught putting blinders on to the other side of what you think might happen, okay, because you don't know, okay. I don't know for sure. You don't know for sure. I'm telling you what I see in the charts. I'm telling you what my numbers say. And if they're right, they're right. If they're wrong, they're wrong. But if you're a gold bull just because you think gold has to go up, you're doing yourself a disservice by putting blinders onto the other side, because gold does look like it wants to go lower, significantly lower. And I don't mean next week or even next month, but I mean into 2015. Don't be surprised when you start seeing 1100, 1050 gold in 2015, because that's what I see coming. Okay, let's move on to oil. Oil's struggling, and it's beating up and down against the $80 level, and it's trying to hold 80, but it might not. But here's the interesting thing, okay? I should have pulled an article earlier, but I forgot. And basically what happened was our friend Dennis Gartman, who we've been using as a market barometer over the last couple of months, he came out today on TV and he called for really, really lower prices in oil. He even had some ridiculous number like 10 that he almost got embarrassed when they pulled it out of him, because apparently he told the producer before he came on air, and then he didn't want to talk about it, and they knew it, so they pulled it out of him, and he got red in the face, and he got embarrassed. And what happens is because it sounds ridiculous, we may have $10 barrel, $10 per barrel oil prices at some point, but not this year, not next year. That's not going to happen anytime soon. You could have $74, $75 barrel, and that's what Goldman Sachs called for today. This morning they downgraded oil to that level. But the fact that they came out and downgraded it, and Gartman came out and told you oil's going way lower, well, he's been wrong every time he's come on TV in the last couple of months. So I'm here to tell you that oil's probably more due for a bounce based on those two things than anything else. Gartman has been a terrible, terrible indicator of what's going on. He's been a great barometer of the other side. And I'm sure he's made a lot of money in his career, and he's been trading a long time, and he's really smart, and he knows his stuff, but he's been wrong way too many times in the last several times he's come on air. He knows it, and he's got to get it turned around, or he's got to stop coming on air, because he's looking like a fool. So all right, so that's it, and that's it on oil. Interest rates, nothing going on. This is the TLT 20-year bond. You see this spike up. That's when interest rates spike lower. There's probably lower prices in bonds, but we could jostle or gyrate around for a while. I just don't have any good reading in terms of are we going up or down in the price of bonds. And certainly over the next, on Wednesday around the Fed announcement, the interest rates and prices of bonds are going to spin around for an hour or two. So there's really no point in trying to figure it out now, because they'll be up, down, all around during the Fed announcement, and then they'll settle in and decide which direction they want to go. I think that's about a wrap for tonight, folks. I'm David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.